Welcome back. Wanted to get to a story that we broke last night on CNBC.com. Been a long time since I was sitting writing a story at around 10 o'clock at night, but it is that one right there, of course, involving Melvin Capital, the well-known hedge fund run by Gabe Plotkin that, of course, got itself stuck into the meme craze, well over a year ago, and it was short GameStop. Since then, of course, performance has been, well, horrible, down 39% last year, down 21% as of the end of the first quarter. That, again, according to sources familiar with Mr. Plotkin's performance. The story, though, is what next? And the what next is the following, that Mr. Plotkin has approached his investors, started to have conversations with them about the idea of essentially closing his fund, so to speak, or allowing those investors who want their money back to take it back as of June 30th. Only for him to then begin again on July 1st with a essentially new fund. He's saying to those investors, you can have your money back or you can let me continue to have it. But the key differential here will be that I no longer have a high water mark. And we should explain what that means. Essentially, in the case of Melvin, for example, if you gave him new capital and then you were down 39 and down 21%, well, you're like 50 cents in the dollar. Maybe even a bit less than that. He's got to get you back to 100 cents in the dollar before he can earn his performance fee. That's the way it goes with hedge funds. That's the way it's always gone. When Jim ran one, that's the way it was for him. And the point is, yeah, you get a chance to get really rich, Mr. Hedge Fund Manager. And, of course, in the case of Mr. Plotkin, that has been, in fact, what happened. He became an immensely wealthy man, bought sports teams, big homes, and everything else. But if you start losing our money, you don't get to make money on our money until you make us whole. He wants to upend that. And he is hoping that the allocators, perhaps, given this choice, will say, yeah, we'd rather just stick with you, especially because it doesn't give them a lot of time to reallocate those funds. We'll see what the reaction is. Certainly a key reaction will be from Stevie Cohen as well. Remember, he, along with Citadel, Ken Griffin, gave about $2.75 billion into the fund last year to help steady things after those significant losses as a result of the meme stock craze. But it is essentially saying, hey, I'm going to get rid of my high water mark. I'm going to be able to begin again. Now, again, what I am hearing from people familiar with the conversations is that he has said he will keep his assets below $5 billion, perhaps starting with as little as $4 billion, still a fairly large hedge fund, and refocus his strategy on what has been one of his key core competencies, namely shorting stocks, until, of course, he got himself stuck in that short at GameStop. But had great success for many years, put up very strong numbers that helped attract enormous amounts of capital that, and this is an old story in the hedge fund business, took him away from that core competency, had him doing things that perhaps he wasn't quite as good at doing. We've seen that many times. And so that at least is the proposition to investors, saying, yeah, I'm not going to get you back to even. I'm not going to work to return your capital to where it was so I can start earning my fee. I'm going to actually change my approach a bit, get smaller, go back to what I know how to do. And this is going to let me keep my people, by the way, because when you have a high watermark that you're never going to reach, well, a lot of your people leave because they're not going to get paid, even though one would imagine, Jim, that you could pay them, I don't know, you could give them parts of the sports team or maybe just part of your own money to keep your people. It will be very interesting to see what happens here. And by the way, if he is successful, my bet is a lot of hedge funds
going to go this way.
Will try and do the same thing.
It is rather incredible. It's not like you're buying vacuum cleaners that return them at full price. But, I mean, this is one of those things where there'll be rich people who will say, hey, I'm with them through thick and thin. And then there are people who say, look, this is just so outrageous. I'm out of here. But they'll probably make a 50-50 split.
And I think that's what he's hoping. I believe he had at least as much as $10 billion in the fund. So he is expecting a lot of capital to be returned. At the same time, as I say, those who allocate for a business, the hedge fund allocators, they probably don't want a huge chunk of capital coming back that they don't know what to do with, because it takes quite some time to do your due diligence on other managers and the like. So it's very interesting. We have seen hedge fund managers who close down, and then a year later they reopen. And again, they have effectively done the same thing, eliminated their high water mark to be able to reopen and make money. But this is sort of a new or novel twist on that from Mr. Plotkin, who I've not spoken with.
Shepard Smith here. Thanks for watching CNBC on YouTube.